Hello and welcome back to another edition of Wealth and Wisdom. I am Kenny Polcari, your host, and today I have the pleasure of speaking to Chris Coney. Now, many of you know Chris Coney and maybe some of you don't. What you should know about Chris Coney is that he is the world's most experienced educator in the field of decentralized finance, otherwise known as DeFi, and cryptocurrencies as well, right? He launched a cryptoverse YouTube channel where he's hosted some 960 videos and interviewed over 97 crypto thought leaders on projects and trends that are and can continue to change the world. He's also one of the few analysts in the world specializing in yield farming, and we could talk about that because it has lost some of its luster, but we should still talk about it because it is still something that happens in that space. But years before joining Weiss Ratings, Chris invested himself in crypto and earned enough money to retire at the ripe old age of 36 years old. So without further ado, ladies and gentlemen, let me introduce to you Chris Coney. Chris, it is a pleasure to always have you back, and especially now, considering everything that's going on in the crypto space with FTX and everyone else that's getting dragged down with it. It's probably a very, very relevant conversation to have with you because I have my own sense about what's going on. I view FTX as being nothing but a fraud. I don't view it as being the end of the decentralized finance world or the end of Bitcoin and Ethereum. I view that as a separate fraud situation, not having anything to do with the relativity of the cryptocurrencies. I don't know how you feel about it, but let's chat.
So there's a couple of things I'll say about that. In my intro, the most experienced educator, that's actually happened by default because I seem to be the only one that has stuck at it. There's been lots of great educators in crypto, even some people that I've learned from. I don't know where they've gone. Right. And it is hard to stick at it when it's cyclical. When it's on a downswing, it's really, really hard to stick around, right? But I've done that in 3 cycles now. And that's de facto made me the most experienced educator because I'm the only one who stuck to it. So that's that, good for me.
Well, good for you. But I think that's what gives you, this added credibility because you have stuck with it when others have just kind of let it go. You've stuck through the cycles. We're in another cycle now. In addition to not only being the cycle, now we're getting hit with, all this news about failures in different exchanges, which isn't helping the conversation. But like I said in the beginning, I don't think that means it's the end of crypto. I think that's just a fraudulent act, right? I think that's I think people have to separate that.
That would be akin to like thinking the world is ending because it snows. It's like, it's just, call it crypto winter. It's just a season, right? And you don't know exactly what the weather's going to be like in the winter, but it's going to be damn miserable, right?
But the crypto winter is separate from what happened in FTX. FTX didn't cause a crypto winter. The crypto winter,
but it's that kind of thing happens in crypto winter. That's what I'm saying.
Oh, I got you.
Okay. You know what I'm saying? It's that kind of thing, just because everyone's under pressure and prices are depressed and companies fail, right? Now, like you're saying, if this turns out to be a massive fraud, that could happen in any cycle, but it would with FTX, it would have been much less likely if the asset price had stayed inflated because the fraud wouldn't have been revealed.
Right. And it would be like saying, the whole Bernie Madoff issue, which was a disaster for the financial services industry, did not mark the end of the financial services industry at all. He was just nothing but a fraud, the same way that FTX is. Right now, people get hurt. I'm not suggesting that nobody didn't get hurt or that we don't feel bad about that, but the fact is, they're 2 separate issues, and I think that initially got lost in the conversation. But I'm hoping that now, I think now, as people kind of sit back and watch it unfold, it becomes clear that this, that SBF, as he's known, was really nothing but fraud. Yeah, it was really
Sam Bankman-Fried. But to your point there, the whole notion of throwing that baby out with the bathwater, think, if FTX collapsed, that means crypto and DeFi are dead. That is akin to saying Bernie Madoff, therefore the idea of having a money manager is dead.
Exactly.
It makes no sense whatsoever.
Exactly. All right. So let's move off that, but let's just talk about the latest crypto winter that we're in, because we are in a crypto winter. So why don't you start by defining, because maybe people don't understand what a crypto winter is. So maybe start by defining that, and then we'll take it from there.
Okay. So a crypto winter, that's another name for a bear market, I would say.
Right.
And in the depths of crypto winter, when most of the prices have gone down as pretty much as far as they're going to go down. Everything's just sort of like low and sideways for a while. And that's where it's kind of hard for people to keep their interest, because what's interesting is when you open your charts in the bull markets and everything's up like 10, 20% a day. And that happens for weeks and weeks at a time. And everyone goes mental. Right? Of course, that's what we all want. But even in 2017, that only lasted like 6 weeks. In the back end of 2017, from mid-November to December, it was only a 6-week period where everything went ballistic. But we want that all the time, but obviously it's not sustainable. So crypto winter's kind of similar. It's this short period of time at the bottom where everyone's like, oh my God, it's uninteresting to most people. I think it's fascinating because for the reason we can talk about, but that's really the optimal point of opportunity as ever.
And so the next question, typically, I don't know if there's no typical time frame per se of bear market. Is there a time frame in your mind of a crypto winter? I hear people talking about, certainly nothing's going to happen in the next 3 weeks till the end of the year. And then we're going to come into 2023. And people are expecting that Bitcoin is once again going to start to lift its head. I heard somebody the other day I think they're on CNBC, and I forget who the guy was, but he says he thinks that Bitcoin is going to be 250,000 by the end of next year.
Interesting prediction.
I thought it was a very interesting prediction. One I don't believe, but I did think it was an interesting prediction for sure.
Yeah. There's this thing nowadays, they call it engagement farming. We talk about yield farming. Engagement farming is where you say stuff that's either patently untrue or a massive stretch of the truth, because it's a battle for attention online, right? So I find that quite kind of tiresome, and I can't do it. I just can't do it.
Well, and so do I. And I heard the guy say it. I looked up. I kind of chuckled because I agree with you, right? Because remember, a year and a half ago, Scaramucci and everyone else was on TV telling that's going to be $1 million by the end of next year. It's going to be 500,000. And meanwhile, where is it? It's 17,000 or 16,000 where it is right now. And meanwhile, you hear nothing from Scaramucci or Novogratz. He's the one. Mikey Novogratz was the one pushing it like there was no tomorrow. And now you haven't heard hide nor hair from Mikey Novogratz. But one way or the other, I think people that remain in the asset class are in it clearly for the long term, right? I don't think this issue has destroyed what crypto is and will become at all.
Right. Because I said this to a friend of mine, Ashley Pugh, the other day. He's shooting this DeFi documentary, and it occurred to me right in the middle of the questioning that there's a conflation about the technology and the asset prices. So I'll set it up like this: the failure of, say, .com companies had absolutely nothing to do with the internet technology or the fact that it was long term going to turn into what it is now. Right, a completely, omnipresent, indispensable, critical, can't remove it now from society level technology, right? Right. That is exactly the same distinction, right? DeFi, in my mind, when people say DeFi in my ear, I picture the technology layer and all the transformation of society that's going to ensue. But what everyone else thinks is DeFi, and the media likes to use and stick the DeFi label on, are the companies and the asset prices. So when the asset prices go down, like Amazon stock going down in the .com bubble crash, they think, oh, the value is going down and the company's burning, means that the technology is useless and it's going to die. But as we know from now the internet is ubiquitous, that's how now you can look into the future of DeFi, right? Every time we go for a cleansing, people are going to say the technology is dead. They're going to say DeFi is dead, but they're not talking about the tech. And I don't think they can separate the two. That's the problem.
Right. And so what does that mean then for investors? Is that walk an investor through, somebody that's just starting? Is that something? What do they need to focus on? They need to focus on the long term. They can't focus on short term. This isn't trading like you got to trade Apple or Amazon, right? It's a long term. Right. It's a long term position.
Sure, it would be like trading Apple when they first got listed,
right?
Because we didn't know how to value it. It wasn't the Apple it is today. All that sort of stuff. It's very liquid, very stable now. Apple.
So do you think that Bitcoin and Ethereum are closer to their bottoms, or do you still think there's more to go?
I'm pretty confident they're close to their bottoms. But the way I invest in DeFi and trade these things, makes that kind of irrelevant anyway. But we can get onto that in a minute.
Well, it's interesting. I asked that question because I own both, but I own them at basically higher prices, right? Because I haven't sold any. I didn't panic when it was all collapsing because it's a small part of my overall portfolio because I want to be in it. I want to feel it. I want to get my feet wet, but I don't want to give myself so much exposure that it's going to hurt me, right? But I do own it at higher prices from where it's trading now. And I've been trying to figure out, do I buy more down here or do I think it's got more room to go on the downside? And so that's why I asked you that question. If you think it's kind of, I think it is also kind of at a level where it seems to find some stability because it's been right in here now for the last 2 months. Hasn't really done anything.
Sure. That's a good question about say if you bought a higher average price and you think, well, is this the bottom? Shall I put some more money in? Shall I wait for it to go down further? Is it going to go down further? I kind of got to the point where I did away with all those predictions, right? Because that's not really the way to long-term success in the markets.
Right.
I like the fact that we call it like taking a position because it's not necessarily your will cannot act on the market. It doesn't respond to the individual's will. It doesn't respond to anybody's will. It just does what it does. So all we can do is position ourselves such that we benefit or we get hurt. So what's that Les Brown quote? Is like life is like a grindstone. It can pulverize you or polish you depending on how you're positioned. And I thought that is perfect analogy to the markets. It can destroy you or it can make you fabulously rich depending on how you position yourself. The market's going to do what it's going to do. It's your positioning that makes the difference, right?
Agreed.
So where I'm going with this is trying to predict isn't a good use of time, in my opinion, right? The positioning piece is, all right, and I say this to my students all the time, I bash them with this over and over and over again. I'm like, right, if you think Bitcoin's going to go down to 10,000, right? It's possible. The question is, what are you going to do if it does? Right. And what are you going to do if it doesn't?
Right.
And you need to have those decisions made in advance.
Right.
Don't wait for it to take a leg down by 40% and then go, panic. That's not cool. That's just not smart.
But no, I think you're right. But that's the way, listen, it's the way I approach also equity investing. I think most investors, you have to make your list. You have to make, okay, what am I going to do here? When am I going to jump back in? Or when am I going to sell it? Right. In my case, it's funny because like I said to you, the Bitcoin and the Ethereum are overall insignificant positions. So I wrote it all the way down, right? I watched it go all the way up. I thought I was brilliant. Like everybody thought they were brilliant. Then I watched it go all the way down. I thought, okay, well, I screwed that one up, but I'm in it for the long term, right? I'm not, like I said, if it goes to zero, it's not going to change my life. And if it goes to 500,000, it will change my life, right? So I'm just hanging out with it.
Sure. But actually, fortunately, the market will forgive you in this instance because it's so early.
Correct.
Right. And the market caps are still relatively so low that you can afford to say buy it at 10K, write it up to 70, and then write it all the way back down to 17 or whatever we are, 16 now.
Right.
Because we're still only gone through 3 or 4 4-year crypto cycles. Right. And we're miles off it being as stable as, say, Apple stock. Right.
So why are there, the way you describe that, you say we've gone through 3 cycles. Are the cycles, do I understand that the cycles are timed like they happen every 4 years because what they split the Bitcoin and they split Ethereum? Is that, explain that theory to me.
Okay, so you might be sticking 2 concepts together there. So on the one hand, we've got the Weiss timing model that was discovered by Juan Villaverde, right?
Right.
So that's brilliant. He through observation, right, by pulling the data out and observing what actually happens, discovered that there is a roughly 4-year cycle in crypto. And they're actually it's like Russian dolls. There are mini cycles within bigger cycles. There's like one big 320-day cycle, and then there are 80-day cycles within that. Then there are 4 20-day cycles within that. Right. So you get that cycles within cycles. Just like mini seasons in the big season. So you get spring, summer, autumn, winter, but it's not like sunny all summer, right? You get fluctuations inside.
If you live in Florida, it's summer all year.
Okay. That's cool. Now that messes the model up somewhat, but that's how we would like it in the markets.
I'm kidding. We do have 2 seasons. We have, I guess the winter and the summer, right? That's really it.
Fair enough.
But even the winter is still summer down in Florida. So,
right. But the model doesn't break. It's still, if you expand it globally, that's generally how the weather works.
Yeah.
So that's that. Now the other question is, and because with different models, you can find what's that thing? Correlation doesn't equal causation thing. So if you just put the Weiss model to the side, there's another, coincidentally, maybe 4-year cycle, which is the Bitcoin halving, where the Bitcoin mining reward is cut in half.
Okay, that's what I meant.
And this is what analysts do, right? We overlay various things like the Bitcoin, the 4-year Bitcoin halving cycle, and then we plot it on top of the price, and we see if there's correlations, and then we'll plot Weiss timing model, and we're looking to see, and this is the best bit. You don't just take one indicator. We overlap several indicators to see where all the confluence is, because the more all the various indicators are in sync, the more accurate view of the truth we've got.
Right.
So it seems, based on historical price patterns, that the Bitcoin halving seems to be the catalyst for major crypto price increases. Now, if you want to ask me why is that, I'm not entirely sure, but it seems to happen, right? So you can either sit around studying why, or you can get on the train.
Right. So now let me ask you a question. Since this kind of whole thing has happened, and we've had this crypto winter, and we've seen Bitcoin collapse, all stuff, have you gotten a lot of investors to call you up, express all kinds of concern, or tell you that they're done with it, or tell you that they can't handle it? Is that you get a lot of that from investors? Or subscribers, or people in your class, or are they looking through it? Do they have strong enough stomach to say, "Listen, I bought into this. I knew this was the way it is going to happen. I'm in it for the long term. Not a problem." So
does that happen to be? I'm going to say not really, because the pool of people that would do that, investors, students, etc., I'm trying not to toot my own horn here, but they've gone through my training,
right,
and they've learned it properly,
right.
And now that I call it like antivirus for the mind. These people are not like metaphorically coming to me when their computer's been infected by a virus and said, "Can you scrub it for me?"
Right.
They don't make those calls, because up front, I metaphorically installed an antivirus in their mind, which is the foundational understanding of how it works, so that when stuff happens, they don't need to call me. They've already got the knowledge to understand what's going on.
I think it's brilliant.
That's good for me, because that means that my phone's not ringing off the hook.
Right. I think that's brilliant. I think you're absolutely right. So let's talk about, you have a new product coming out, right? And I think Weiss is defining it as, tell me what.
It's the 2023 DeFi Masterclass.
Okay, but you define it as the Sideways Siphon.
Well, that's the strategy that I teach in the masterclass.
Okay. So there you go. So then I misunderstood it. So tell us tease us a little bit just about what that is and what people should understand, so they should sign up for this class.
Sure. So the Sideways Siphon, this is a proprietary DeFi trading strategy that I came up with in the great bear market of 2022. And it sort of evolved naturally and out of necessity, really. That thing, adversity is the mother of invention. So I'm sat there, in the bear market. And the thing about bear markets is, when, just like in winter, everyone gets cold, right? So in a bear market, there are very few strategies you can deploy other than staying out of the market or putting on a short position. That's pretty much it, because everything's going down. Everyone's losing money in the market. So your options are get out of the market or short it, right? Or use options or something like that. But it's much easier to make money when the price is going up, because even if you're bad timing, you still make money. Everyone's a genius in the bull market.
Right.
But I'm like, that's not good enough for me. I'm supposed to be this, world-renowned DeFi expert, crypto investor, yada, yada. So I need stuff that works, right? That's up to me, really. If I want to take my responsibility seriously, people are looking to me. So, and also I want to make money in the markets as well, right? So it's kind of win-win. So I'm like, right. So I just started really looking hard at it. I'm like, how do you extract profit from these terrible market conditions, right? Anyway, this led to the invention of what I call the Sideways Siphon strategy. And it's based on the idea of, it's a picks and shovels strategy, meaning in the Old West, when there was a gold rush, everyone moved to the Western towns because everyone wanted to become a gold prospector and get rich, right?
Yep.
So everyone would go up in the hills and they'd pan for gold, and millions and millions of people would just sell up and move to the West to make their fortune. That's analogous to trying to pick the next DeFi coin that's going to go up 1,000x.
Yeah.
For every million people that move to the West and start panning for gold, maybe only one of them strikes gold and becomes fabulously rich. Everyone thinks that's going to be them, but 900,000 of them go home empty-handed and with a bunch of equipment they can't use anymore, like picks and shovels and so on. So the smart guy is the one that opens up a store in the Western town selling hard hats, picks, shovels, prospecting pans, all that kind of stuff, right? Yeah. And he doesn't necessarily care if there are any gold in their hills.
That's right.
All he cares about is that he places the store near the hill and everyone stops off to buy picks and shovels and yada, 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 thereby profiting from the gold rush without having to risk, his capital.
Right. Looking for gold.
So based on what the Sideways Siphon strategy is, it leverages these new decentralized exchanges to basically set up the equivalent of a picks and shovel store in crypto.
Okay, so wait a minute. Stop there for 1 minute. Stop there for 1 minute. So then define that just so the audience understands. When you say leverage the DeFi exchanges, so identify, is it Coinbase?
No, it's none of the companies you've heard of, but let's use that as a bridge, right? So I've always envied the Coinbases and the Binances of the world because yes, they are impacted by crypto bull markets and bear markets purely because their profit comes from the trading fees and their trading revenues are obviously dependent upon trading volumes. Yeah. And in bull markets, trading volumes are skyrocket, and in bear markets, trading volumes tail off. So that's okay. Their revenue is going to go up and down with the cycles as well. But their risk, they're not staking their capital on bull and bear markets. It's just their sales revenue fluctuates. But as long as the crypto's trading, they're earning fees, but they don't have to risk staking any money on any particular asset. As long as assets that they list are being traded, just like any stock exchange, they just sit back and take a piece of the entire liquidity, right?
Right. Yeah.
So that's the envious position to be in because you just, you take a spread on the, you siphon, pardon me, if you siphon a bit off the entire industry's activity, just like the guy selling the picks and shovels.
Right.
Now, up until DeFi was invented, to get in that business, you'd have to have a lot of capital, a technology, you'd have to build the exchange and get regulated. Oh my God. Just it's not for the average person. Just like Bitcoin mining is now beyond the pale for most people. But with the advent of blockchain technology and things like Ethereum and smart contracts and decentralized applications, these exchanges like Coinbase and Binance have basically been automated out of existence. Now, they're still there because they provide a service that's easy, but just like the internet put the libraries out of business by having all the information accessible to anywhere from anyone, this is similar. So instead of having to go to a company that built an exchange to match buyers and sellers, these smart contract-based decentralized exchanges are built on the blockchain and run autonomously so that people can go and just directly swap assets between themselves. Now, the thing about that, though, is that an exchange needs liquidity, right? So that when you want to buy a Bitcoin or an Ethereum, someone needs to take the other side of that trade. That's the purpose of Binance and Coinbase. They have a platform that matches buyers and sellers. But if you're a decentralized exchange, then how do you do that? Well, the way that this works is that investors like me and my students, you can stake your crypto assets, stable coins, Bitcoin, Ethereum, in the decentralized exchange, almost like to fund the bankroll, right? Think about a casino, right? They take a spread of everything that goes across the tables, but they need enough of a bankroll to pay out the winners and collect all the money from the losers. That's basically how these decentralized exchanges work. You can be a trader and you can go and swap assets in the hope that the one you buy goes up, or you can go on the other side of it, right? And you can basically be the house and fund the decentralized exchange's liquidity and then take the other side of everybody's trade. The reason you might want to do that is twofold. One, it's like selling the picks and shovels. And secondly, most people who trade lose money. So if that's the case, wouldn't you want to be on the other side of that?
You would.
Right.
Yes, you do.
So going back to the start here, we're in the depths of the bear market. Prices are just going nowhere, right? Just sideways. So the sideways siphon strategy is a way of setting yourself up to basically do what Binance does without having to invest billions of dollars in being an exchange. You just stake an amount of crypto assets, can be anywhere from $10 upwards, and then you're effectively running a little mini exchange of your own and then siphoning fees off of all the traders that trade backwards and forwards, right? And this is how, in this terrible bear market, that I've been doing eye-popping yields, which it sounds too good to be true, but they are true.
Okay, and so now this masterclass that Weiss is launching actually launches when?
13th of December.
Okay, great. And so in that class, subscribers or the students in that class are going to learn this strategy, how you do it, how they can do it.
Yes, I'm going to learn three things in that masterclass. One is basic how to earn higher yields on your stable coins, which is the easiest, lowest risk, strategy in DeFi. Then you'll learn. Do you want a question there?
No, go ahead. I have a question, but I want you to finish.
So that's like low level risk. Yeah. Decent returns. You're like 9-10% on your stable coins with no market price risk. Then you can go a level up from that where we teach the sideways siphon. Then you're looking at 40, 50, 60% annual yields by taking a little bit of market price risk, again, being on the other side of other people's trades. And then the third level is the gold rush folk, where you can buy crypto assets that have the highest chance of going up. And we have a particular recommendation in that regard where you don't have to risk your own money in buying these tokens. Now that sounds, you have to come to the masterclass to fully understand what that means, but you can get some of these DeFi coins without actually paying for them, so that whether they go to the moon or to the floor, it doesn't matter. So yeah, you'll have to see at the masterclass.
Now, is that a separate masterclass than the one we're talking about? Or is that
it's all that's in there?
It's all in that in this masterclass.
Yep.
Okay, that's fascinating. But let me ask you a question, because here's what I wanted to just hit on. The first thing you said was the very kind of first low about yield hunting. Isn't yield hunting a thing of the past, considering what's gone on in that space, or have I misunderstood that?
Okay, so Crypto Yield Hunter is my premium newsletter.
Okay.
Whereas yield farming, I think is what you're talking about.
Yield farming, right,
is the original model for extracting large yields from DeFi.
Right.
So that's still a thing.
Does that still exist?
That still exists. Absolutely. Yeah, absolutely. But the Sideways Siphon is based on the sort of next evolution of that, which is known as real yield. The thing about yield farming is the reason the APYs are so eye-poppingly spectacular is because the yields are enhanced by inflating some kind of native token of the app that you're using, right? Which obviously is unsustainable unless that app takes off and becomes dominant. The token you're earning as yield, won't end up being worth anything. So the safest way to do yield farming is to earn that enhanced yield in whatever the special token is, and then immediately swap it into something more blue chip like a Bitcoin and Ethereum, or preferably stable coins. Because that way, even if this inflationary token is going to zero, you've still got run away with your decent yield without having exposure to it.
So let me ask a question about the masterclass. Yeah, let me ask a question about the masterclass. Is the masterclass a class? It's a video that I can watch on my own time, or is it a specific time and place that I have to attend? Okay,
so there are three answers to that. One, the masterclass itself, the introductory masterclass that's coming up on like the 13th. Yeah. That is going to be at a specific time, right? So you tune in for it's like
tune in.
It's about an hour, and then we go through those three strategies: stable coins, sideways siphon, and then how to get the DeFi coins that might moon without actually having to pay for them. Right. So that's that masterclass. Then, if you like that, you can join the full-blown masterclass, which is the online course bit. That's pre-recorded training material, but also I probably shouldn't reveal this, but I'm going to reveal it anyway. Part of the formal masterclass, if you want to sign up, is something brand new that I'm introducing, which is these quarterly DeFi power workshops, which will be basically these Zoom style seminars, live and interactive, which will be held like a live event, like at a specific time where I'll show up like this, and the students can show up either on video or on chat and then grill me, right? Whatever the gaps in your knowledge is, just stick them in the chat, ask me for real, and then I'll do all that interactivity in real time. So you've got the bulk of the training as pre-recorded videos, do it in your own time. Then if you want some polishing, you come to the power workshops and then just ask me directly.
Right. And the masterclass the 2023 masterclass is also a specific time and place that people are going to have to attend.
Yes, the free introductory session, that one on the 13th of December, that is going to be a specific time. Yeah. So
what do you know what time that is yet?
I do not know what time that is. No.
Okay, so we'll have to. We should make sure we find that out.
Sure.
Because the 13th is Tuesday.
Yeah, that's right. Yeah, I think the email invites are starting to go out now. Yeah, because we were working on this morning.
Yeah, I think that's great. And so what the listeners should understand is that you are someone that has an unbelievable wealth of knowledge in the space, but your ability to teach it and educate it and talk about it brings it down to a level that first timers can understand, right? You don't speak on this level of being so educated that I have no idea what you're talking about, right? You make it clear, you make it concise, you make it easy to understand, and then you make it even easier because now I can join a power class and actually grill you, right? Ask you questions and you're going to answer me directly.
Absolutely.
Which I think is a fantastic opportunity for people that want to play in the DeFi space. They want to get to know it. They want to get to understand it. And now, especially this new strategy that you've designed, that you've tried yourself, you have been using, and you have a real history of it being successful. So I think I think the subscribers and the listeners should be well aware of that, and I think they are. I think you made that very clear. And so I'm hoping that you're going to get a lot of people signing up for this, because I do think it's a space, like I said at the very beginning, it's not going away. It's not going away at all. And so people need to get better educated about it. They need to understand it. They need to understand, both the pros and the cons, and kind of the initial difficulties as we are now still. Like you said at the beginning, it's still in its infancy stage. And so there's a huge amount of time and opportunity for people to jump in and learn and take advantage.
Absolutely. So just skipping back one step here, I've just pulled up one of the emails. It's Tuesday, December the 13th at 2 p.m. Eastern.
2 p.m. Eastern. Okay, that's great. So that's Tuesday afternoon. Check my schedule right now because I'm gonna have to put that in my book to make sure that I'm available. And guess what? I'm available on Tuesday at 2 p.m. So that's perfect. All right.
So that's dealt with.
I'm gonna have to sign up for that.
So to move back onto what you were saying there, I wrote an article for Wise Crypto Alert recently, where I just quite frankly pointed out my point of view about that phrase. When people say those who can't teach, that's really galled me over the years because I'm a professional educator. So I'm like, that just galls me. Right. So I'm going to rephrase that and say that those who can't should not teach.
Right.
And the reason I say that is because anyone who can't, that is teaching, can't be certain what they're teaching works.
Correct. I agree with you. I agree with you 100%.
You know what I'm saying? Is the criticism of, say, I don't know, someone teaching business studies at university that's never worked in or run a business. Never had a business. You've got to really be skeptical about what they're saying, right?
Yeah.
I mean, you could say, well, they've extracted the knowledge from people that do know. That's very different from coming from the mind that can do it.
Exactly right. And so I agree with you. And you are someone that not only does it, but you educate about it. You've got a history to prove it, which makes you much more credible, which is why people should really be signing up for this and paying attention to not only what you say, but what you teach and how you teach it, because I think it's amazing.
Sure. It's funny. I've approached it kind of backwards, really. I didn't really, this is true, and I've never said this publicly before, because I guess I didn't really realize this for myself. When I got into it with the intention of teaching it. But then I also knew the only way I could teach it effectively is if I could do it. So the only way I've figured out crypto and the trading and all that, bought Dash at $9 and so on, that wasn't to make me rich, really. That wasn't really my intention.
It was to educate yourself.
No, it was to figure out how it worked so I could transfer that knowledge.
Exactly.
That was my primary intention. It wasn't like, oh, Chris Coney was this mad trader, investor, and then thought, oh, I'll teach other people. That mission to educate came first.
Right.
Right. So I figured it out, how it works, in order to teach it, which is kind of a strange approach, if you ask me. But that's the way it went.
But it's a realistic approach because you now have, like you said, you do it. You have the experience. You're successful at it. So it makes perfect sense that if somebody's going to teach it and somebody's going to actually sign up to listen to you, that you bring that credibility to the table, right? I think it's always amazing. Like you say, you go to a university, you got some guy teaching you about business. He doesn't know the first thing because he's never actually run a business. He's read a bunch of books, but he's never run the business. I find that always amazing, right? So it's great to get kind of broad knowledge about it, but it's much better when you're talking to someone who's actually jumped in feet first, is up to their eyeballs in risk and understands it, and then is able to transfer it and educate. I think that's what separates you from a lot of other people in the crowd, for sure.
I feel bad for the business university lecturer because that person, he, she, whoever, is missing out on so much satisfaction by applying their knowledge.
Agreed.
Or they're just missing out, man. I'm telling you.
Yeah, agreed. Yeah, it's very funny because, I'm for one, I spent 40 years in the financial services industry. I've gone to different universities saying, listen, I'm here to lecture. I'm here to help. I'm here to teach. But you know what the answer is? Well, you don't have a PhD, so you can't teach. Okay, so a PhD. In fact, I do have a PhD because I got 40 years of real business experience. So I do have a PhD. Anyway, it's a whole other conversation. In any event, listen, Chris, you and I have been chatting here for about 40 minutes, and I appreciate your time because I know you're very busy. You're getting ready for this new masterclass for the launch on Tuesday, December 13th at 2 p.m. Eastern Standard Time. So I don't want to take up any more of your time because I know you got a lot to do, but I truly appreciate this. And then I want to circle back after you launch this product, after you've done this masterclass. I want to talk about feedback. I want to talk about how it went. I want to talk about what people are saying about it. And listen, and I'll be there as well. So I'll have my own view on what I thought, but it'll be much more interesting to see what you think about how it went.
Sure. Absolutely.
In any event, it's always a pleasure. And I want you to have a great day.
Likewise, sir. Thank you very much for having me once more.
All right. Bye-bye.